Booyah, folks, welcome to the jungle. Today, May 22nd, 2025, Wall Street is a roller coaster, a real nail-biter, and you know who's at the controls? Well, it's a mixed bag, but the big news shaking the screens is President Trump's tax bill getting the green light from the House. This isn't just some minor tremor, this is an earthquake shaking the very foundations of our portfolios. We saw a mixed performance across the board, a push and pull that tells you investors are wrestling with what this all means. Some are seeing dollar signs, others are seeing red flags, and the market is reflecting that uncertainty, that tug-of-war between greed and fear. It's a classic Wall Street drama, playing out in real time, and you need to be paying attention, folks. The air is thick with anticipation, and let me tell you, the whispers in the trading pits have turned into shouts. This tax bill, a revival of the 2017 cuts, is a massive gamble, and the market knows it. We're talking about a potential surge in the nation's debt, and that's got a lot of smart money feeling skittish. After the House squeaked this thing through by a single vote, you could practically hear a pin drop. Then the algorithms went wild. The computers are trying to price in everything, the good, the bad, and the downright ugly. This isn't just about numbers, it's about psychology, it's about confidence, or the lack thereof. The immediate reaction was like watching a tennis match, with stocks bouncing back and forth. You had futures wobbling, with S&P 500 futures trying to find their footing, Nasdaq 100 futures hinting at some tech optimism, but Dow futures were looking a little queasy. This kind of divergence tells you the market is trying to digest a complex meal. It's not a simple buy everything or sell everything day. No sir, this is a stock picker's market, where you need to understand the nuances, the sector-specific impacts, and the broader economic currents. The tax bill isn't a rising tide lifting all boats. It's more like a series of targeted currents. What we're witnessing is a critical juncture, a moment where policy decisions in Washington send powerful ripples through every investor's account. The extension of tax cuts sounds good on paper for some, maybe putting more money in people's pockets, potentially boosting corporate earnings. But, and this is a big but, the concern over the deficit, already sitting at a staggering $36 trillion, is a heavy cloud hanging over the festivities. Moody's already fired a warning shot by downgrading the U.S. credit rating based on this proposal, and that's not something you just brush off. This is serious business, folks, and the market is taking it seriously. So let's break down this beast, this tax and spending package that President Trump managed to push through the House. We're talking about an extension of those 2017 tax cuts, the ones that juiced the market back then. But here's the kicker, folks. This bill also jacks up the nation's debt ceiling by a whopping $4 trillion. $4 trillion! That's not chump change, that's a mountain of IOUs that someone someday is going to have to pay back. And Wall Street, well, Wall Street's looking at that number and getting a little green around the gills. They're worried, and frankly they should be. This kind of spending spree can have consequences. The passage of this bill was a political nail-biter secured by a single vote. To get those conservative Republicans on board, there were some last-minute sweeteners, like a more generous salt tax deduction. Politics is the art of compromise, they say, but when the compromise involves adding trillions to the national deficit, you've got to ask if the price is too high. The existing $36 trillion deficit is already a monster under the bed, and this bill is like feeding it a 7-course meal. Moody's wasn't kidding when they flagged this as a reason for their U.S. credit rating downgrade. They see the storm clouds gathering, and so should you. Now, some people will tell you that tax cuts pay for themselves. They'll say it stimulates the economy, businesses will invest, jobs will be created, and everyone will be swimming in dough. I've heard that song before, and sometimes it hits the right notes, but other times it's just a lot of noise. The reality is that these cuts, especially when they're not offset by spending reductions elsewhere, can blow a huge hole in the budget. And when the government has to borrow more, that can push up interest rates, making it more expensive for businesses and consumers alike. It's a delicate balancing act, and right now the scales look a little tilted. And here's another angle that's got specific sectors shaking in their boots. The bill speeds up the phase-out of clean energy tax credits. This is a direct hit to companies in the wind and solar space. Those provisions were designed to boost green energy, to help us transition to a cleaner future. Now, that support is being weakened, and you can bet your bottom dollar that those stocks are feeling the pain. We'll get more into that later, but it's a clear example of how this bill isn't just about broad strokes. It's got very specific winners and losers. This isn't just economics, folks, it's policy with sharp teeth. Alright, let's get down to brass tacks and look at how the major indices are behaving amidst this tax bill turbulence. It's a mixed picture, a real head-scratcher for anyone expecting a unified chorus from the market. The Dow Jones Industrial Average, that granddaddy of indices, was roughly flat as of mid-morning, struggling to find direction. This comes after it took a nearly 2% nosedive on Wednesday, so flat is maybe a small mercy, but it's hardly a vote of confidence. It tells me the big established companies in the Dow are still trying to figure out if this tax bill is a friend or a foe in the long run. Then you've got the S&P 500, the broader measure of the market. It managed to eke out a small gain, up about 0.1%. That's not exactly setting the world on fire, but it suggests a little more resilience, perhaps a sense that while there are concerns, there might also be some opportunities. Earlier, at the opening bell, the Dow was actually down about 0.2%, and the S&P 500 was hovering near the flat line, so there's been a bit of a struggle, a bit of a fight to stay positive. It's like the market is testing the waters, dipping a toe in before deciding whether to take a full plunge. But here's where things get interesting, folks. The Nasdaq Composite, home to all those tech darlings and growth-oriented companies, actually jumped. It was up 0.6%, hitting 18,959.55. That's a significant move, especially when the other indices are looking more subdued. This tells you that some investors believe the tech sector might be better positioned to navigate this environment. Or perhaps they see more upside from certain aspects of the bill. Or maybe they're just less worried about the debt implications for their specific high-growth plays. The Nasdaq's strength is a key storyline today. Even before the market officially opened, the futures market was giving us clues about this divergence. S&P 500 futures were treading water. Nasdaq 100 futures were showing a bit of pep, up 0.2%, while Dow Jones Industrial Average futures were already signaling weakness, down 0.1%. This pre-market action often sets the tone, and today it highlighted the differing sentiments across different segments of the market. It's not a one-size-fits-all reaction. It's a complex tapestry of hopes, fears, and strategic bets. The tax bill is the catalyst, but the reactions are as varied as the stocks themselves. Now, let's pivot from stocks to the bond market, because what's happening there is huge, folks, absolutely monumental. Longer-dated bond yields are on the rise, and they're not just creeping up, they're surging. The 30-year Treasury yield, that's the long bond, has climbed above 5.1%. Think about that. We're nearing highs we haven't seen since the financial crisis. This is a big, flashing warning sign that the bond market is getting seriously nervous about inflation and the government's borrowing needs, especially with this new tax bill adding to the debt pile. It means the cost of borrowing for Uncle Sam is going up, and that has ripple effects everywhere. And it's not just the 30-year, the benchmark 10-year Treasury yield is also feeling the heat, rising above 4.58%. Why should you care about bond yields? Because they are the bedrock of our financial system. They influence everything from mortgage rates to car loans to the interest rates on your savings accounts. When these yields go up, it generally means borrowing costs for everyone go up. This can put a damper on economic growth, as businesses might think twice about investing, and consumers might cut back on big purchases. The bond vigilantes are awake, and they are making their presence felt. The connection to the tax bill is crystal clear. When the government plans to borrow an additional $4 trillion on top of its existing massive debt, bond investors demand a higher return for lending their money. They see increased risk. The risk of inflation eroding their returns, the risk of the government struggling to manage its finances. So they sell existing bonds, which pushes prices down and yields up. It's a classic supply and demand story. More supply of government debt means lower prices and higher yields to attract buyers. This is the market's way of saying, hey, we're concerned about this fiscal path. This rise in yields creates a more challenging environment for stocks too. Higher bond yields make bonds a more attractive alternative to equities, especially for conservative investors. If you can get a relatively safe 5% return on a government bond, why take the risk in the stock market? This can pull money out of stocks or at least make investors more selective. Furthermore, for companies, higher borrowing costs can eat into profits, which is never good for share prices. So keep your eyes glued to those bond yields, folks. They are telling a very important story right now, a story of unease and shifting expectations. Section 5. Economic pulse, PMI, jobless claims, and the penny's farewell. Beyond the immediate market jitters and bond yield surges, we've got some fresh economic data giving us a pulse check on the broader economy. And it's a mixed bag, just like everything else today. First up, the S&P Global Flash, US Composite PMI. That's a mouthful, but it's a key indicator of business activity. It actually rebounded to 52.1 in May from 50.6 in April. Anything above 50 means expansion, so this is good news. Both services and manufacturing showed increased activity. Business confidence apparently got a little boost from a pause on higher rate tariffs. So, there's some underlying strength there, which is encouraging. However, don't break out the champagne just yet because the tariff situation is still a thorn in our side. The data also showed that these tariffs are pushing prices higher and causing more supply chain headaches. We're seeing supply chain delays that are the most prevalent since way back in 2022. And guess what happens when supply chains get gummed up and costs go up? Businesses pass those costs on to you, the consumer. The overall rise in prices charged for goods and services in May was the steepest since August 2022. That's inflation, folks, and it's not going away quietly. This complicates the Fed's job immensely. Then we have the labor market, which has been the bedrock of the economy for a while. But we're seeing some cracks appear. For the week ending May 17th, initial jobless claims totaled 227,000. That's not a terrible number in isolation, but continuing jobless claims hit 1.9 million. More importantly, the 4-week moving average for continuing claims, which smooths out the weekly volatility, has risen to its highest level since November 2021. This is a clear signal that the labor market is softening. More people are staying unemployed for longer, and that's a trend we need to watch very, very closely. And in a quirky bit of economic news, get ready to say goodbye to the penny. The US Treasury announced it will stop minting new pennies next year. They say it'll save the government about $56 million annually because, get this, it actually cost the Treasury $85 million more than they were worth to make them last year. So, from next year, cash transactions will need to be rounded to the nearest 5 cents. It's a small change in the grand scheme of things, perhaps, but it's another sign of the times, an effort to find savings wherever possible, even in our pockets. It's the end of an era for Honest Abe on the copper coin. Section 6. Crypto craze Bitcoin blasts off, Etherize new heights. Hold on to your hats, crypto fanatics, because the digital frontier is absolutely on fire today. While traditional markets are wrestling with tax bills and deficits, Bitcoin is blasting off to another galaxy. The king of crypto, BTC USD, topped $111,000 for the first time ever. Yes, you heard that right. Over $111,000 per coin. It surged over 3% to hit $111,878. This isn't just a rally, it's a rocket launch, fueled by a perfect storm of positive sentiment. The White House is making encouraging noises, institutional investors are piling in, and there's even progress on a stablecoin bill in the US Senate. This incredible surge shows that the appetite for Bitcoin is insatiable right now. Forget the skeptics, forget the naysayers. The momentum is undeniable. When you see this kind of buying pressure, it tells you that big money is getting involved, and they're not just dipping their toes, they're diving in head first. The narrative around Bitcoin as a store of value, as digital gold, is clearly resonating louder than ever, especially in times of uncertainty in traditional financial markets. Investors are looking for alternatives, for assets that march to the beat of their own drum, and Bitcoin is fitting that bill perfectly. And it's not just Bitcoin having all the fun. Ether, the number 2 crypto, ETH/USD, is also basking in the glow of institutional affection. It also posted strong gains, with Ether at one point up about 5.5%. This isn't just a sympathy rally. Ether has its own powerful fundamentals, with its smart contract capabilities and the vast ecosystem built on its blockchain. The growing institutional demand for Ether is a testament to its utility and its potential. As more and more sophisticated investors get comfortable with digital assets, they're diversifying beyond Bitcoin, and Ether is a natural next stop. The crypto party is in full swing, folks. The positive regulatory wins are also playing a huge role here. For years, the crypto industry has been craving clarity from Washington, and it looks like we're finally starting to see some progress. The advancement of a stablecoin bill in the Senate is a significant step. It signals that lawmakers are beginning to understand the importance of this asset class and are working towards creating a framework for it to thrive. This kind of regulatory progress reduces uncertainty, and that's like rocket fuel for prices. The future looks bright for crypto, but as always, remember it's a volatile space. Buckle up. Section 7, Clean Energy Carnage, Tax Bill, Torpedoes, Solar Stocks. Now, let's talk about a sector that's feeling the full wrath of this new tax bill, clean energy. Folks, it's a bloodbath out there for solar stocks. This is a direct consequence of the legislation speeding up the phase-out of clean energy tax credits. Those credits were a lifeline for many of these companies, helping to make solar and wind power more competitive with fossil fuels. With that support being pulled back sooner than expected, investors are running for the exits, and they are not looking back. It's a brutal reminder of how quickly government policy can change fortunes on Wall Street. Just look at these numbers. They are absolutely staggering. Sunrun, one of the big names in residential solar, saw its stock plummet by an unbelievable 43%. 43%. That's not a dip, that's a crater. Enphase Energy, which makes microinverters for solar panels, dropped a painful 18%. SolarEdge Technologies, another major player in solar inverters and power optimizers, fell 15%. Even First Solar, often seen as one of the more resilient names in the sector, dipped 5%. This is widespread panic selling, driven by a fundamental shift in the industry's outlook. The message from the market is loud and clear. The anticipated runway for growth in clean energy, supported by government incentives, just got a whole lot shorter. These companies had business models and projections built around those tax credits. Now they have to recalibrate, and investors are not waiting around to see how they'll manage. This is a classic example of policy risk, something I always warn you about. You can have the best technology, the best management, but if the government changes the rules of the game, your stock can get clobbered. It's a tough lesson for those who were heavily invested in this space. What does this mean for the future of clean energy? It's certainly a setback. While the long-term trend towards renewable energy is likely to continue, driven by climate concerns and falling technology costs, this abrupt change in policy creates a significant headwind. Companies will need to innovate even faster, become even more efficient, and perhaps seek alternative funding mechanisms. For investors, it means being incredibly selective and understanding the new, less certain landscape. The sun may still be shining, but a dark cloud has just passed over the solar sector, and it's raining losses. Section 8, Corporate Capers, Coinbase, Nike, and Snowflake in the spotlight. Beyond the broad market moves and sector-specific drama, we've got some individual company stories that are making waves today. First up, let's talk about Coinbase, the big crypto exchange. Their stock actually fell 7% on the day they announced a data breach. Now, this breach happened last week, and it was caused by something pretty concerning: bribing retail customer service agents in India. They say it affected less than 1% of monthly transacting users. But any breach is bad news, especially when you're dealing with people's money and digital assets. The stock has since recovered some ground and is now down roughly 1% from its closing price before they disclosed the breach. It's a reminder of the operational risks in the fast-moving crypto space. Then we have a household name, Nike, and they are lacing up for a win. Their shares rose a solid 2% in pre-market trading, and for good reason. First, they announced they're going to be raising prices next week. We're talking $2 to $10 more for adult apparel and equipment, and about $5 more for items in the $100 to $150 range. In this inflationary environment, pricing power is king, and Nike is flexing its muscles. But the even bigger news, folks, is that Nike plans to resume selling its products on Amazon after a 6-year hiatus. This is huge. Access to Amazon's massive customer base could be a significant revenue booster for the swoosh. Switching gears to the tech world, Snowflake, the data cloud company, is having a fantastic day. Their stock soared 9% in pre-market trading. Why the celebration? They raised their fiscal 2026 product revenue forecast. That's a big vote of confidence in their future growth. Plus, they beat their Q1 estimates. What's driving this? Strong demand for data analytics and, you guessed it, AI spending. Companies are desperate to harness the power of their data, and artificial intelligence is at the heart of that. Snowflake is positioning itself as a key enabler of this trend, and investors are rewarding them handsomely for it. This is a pure play on the data and AI revolution. These individual stock movements highlight the fact that even on a day dominated by big macroeconomic news like the tax bill, company-specific fundamentals still matter. A data breach can spook investors, even in a hot sector like crypto. Smart strategic moves like Nike's return to Amazon and its price increases can drive a stock higher. And strong performance coupled with a bullish outlook in a high-growth area like AI and data analytics, as seen with Snowflake, can lead to significant gains. It's a reminder that you need to do your homework on individual companies, not just ride the market waves. Know what you own. Section 9, the final bell, economic sentiment, and what's next for the street. So, as the trading day churns on, what's the overall feeling, the economic sentiment out there? It's cautious, folks. Very cautious. You've got the House passing this massive tax and spending package which, while potentially offering some short-term stimulus, is raising serious red flags about the long-term health of the nation's finances. The surge in bond yields is the market's way of screaming, "We're worried about debt and inflation." This isn't a time for complacency. It's a time for vigilance and careful consideration of where you're putting your hard-earned money. The easy money days, if they were ever truly here, are certainly looking more challenging. We even heard from Jamie Dimon, the big boss over at JP Morgan Chase. He's out there warning about the risk of US stagflation. Stagflation. That's the ugly combination of stagnant economic growth and high inflation, a real nightmare scenario for policymakers and investors alike. Dimon also said the Fed is right to hold interest rates where they are, suggesting that the fight against inflation is far from over. When a heavyweight like Jamie Dimon sounds the alarm, you better believe people on Wall Street are listening. His comments add another layer of sobriety to the current market environment, tempering any irrational exuberance. Looking ahead, the projections are, frankly, a bit murky. The tax bill's full impact will take time to unfold. Will it supercharge the economy as proponents hope? Or will it lead to an unsustainable debt spiral and higher inflation as critics fear? The truth is likely somewhere in between, but the uncertainty itself is a headwind for markets. We're also keeping an eye on oil prices, which fell overnight Wednesday before recovering a bit. Brent crude is trading below $65 a barrel, and West Texas Intermediate is above $61. Rising U.S. commercial crude inventories are also part of that puzzle, suggesting demand might not be as robust as hoped. Ultimately, navigating these choppy waters requires a steady hand and a clear strategy. The mixed signals from the major indices, the stress in the bond market, the divergent fortunes of various sectors like clean energy and crypto, it all points to a complex and evolving landscape. Don't get caught up in the daily noise without a plan. Understand your risk tolerance, diversify your holdings, and focus on quality companies with strong fundamentals and pricing power. The stock market roller coaster will continue to have its ups and downs, but with smart investing, you can aim to come out ahead in the long run. Stay informed, stay disciplined, and don't be afraid to take some profits when the market gives them to you. Booyah!